Interest rates are rising. The Fed will continue to increase rates to combat inflation. My name is Alison Williams, and I'm Senior Vice President and Chief Production Officer at Walker Dunlop. My team focuses on financing multifamily assets across the U.S. Today, you will hear from our capital markets and agency experts about what tactics and strategies investors should consider when financing their next multifamily asset in the small and middle market arena. There is no need to sit on the sidelines in fear. Good afternoon, and welcome to Walker & Dunlop's webinar. My name is Alison Williams, and I am Senior Vice President and Chief Production Officer at Walker & Dunlop in our multifamily loan platform. Although many of you are familiar with Walker & Dunlop, I want to spend a couple of minutes providing the balance of our guests an overview of our firm. Walker & Dunlop is a commercial real estate finance company with a national lending platform that spans coast to coast. In 2021, our total transaction volume exceeded $68 billion with a large focus on multifamily assets. Many investors associate Walker & Dunlop with large Class A multifamily assets, but in reality, we finance loans ranging from $1 million to multi-billion-dollar portfolios. We also are largely focused on providing financing for workforce housing throughout the US. Before I introduce our speakers, a few housekeeping items. You all will be receiving a copy of the slides after today's presentation. We will also open up the audio at the end and spend 10 minutes on Q&A. Today, I am joined by my colleagues and friends, Allison Herrera and Tim Cotter. Allison and Tim specialize in financing multifamily assets in the small to middle market space, and combined, they have over 36 years of experience originating loans for commercial real estate across the US. Well, let's jump in. We've got a lot to cover in the next 45 minutes. Tim, let's start with you. The week's been pretty wild. I think no one was really expecting such a big jump in the Treasury on Monday, and then the Fed raised the Fed fund rate by 75 basis points just yesterday. Given the recent events, can you give us an overview of the US Treasury Index, and also what have we seen historically?
Yeah, thanks, Allie, for the introduction and for the opportunity to share some insight today. In terms of interest rates, Treasury indexes have more than doubled, a quick run up in the past 6 months. Looking here at the chart, the 10-year Treasury, this hit an all-time low just after the onset of the pandemic and the shutdown. It closed at about 52 basis points in early 2020. And we climbed from there. We ended the year just last year, 2021, at about 1.5%. Fast forward to the end of the first quarter, 2022, in April, we were up 100 basis points. And then finally, just earlier this week, we peaked at 3.48%, which is up about 200 basis points from where we ended the year. So what's driving all this? Number one, it's inflation. The Fed is working to quell inflation by driving up the Fed funds rate. Last week, we saw a higher than expected CPI report. And the Fed responded by increasing interest rates, the Fed funds rate by 75 basis points yesterday. And that was the largest increase since 1994. Our expectations are that there's probably another 75 basis point hike in July and more to come after that. So in the end, a lot of economists are thinking that the Fed's going to settle out at about 3.5% by year end for Fed funds, and that's up from 0 earlier this year, essentially. But I guess when you step back and you look at this from a historical context, things don't look so severe. We've been here before. In 2018, the 10-year hovered above 3% for most of the back half of the year. And going even further back, if you kind of look at pre-Great Recession, call it like 2000 to 2007, when I was starting my career, the 10-year Treasury was hovering between 4% and 6%. So I think that's important to note because that was a very active time for commercial real estate development and lending.
Yeah, I think you're so spot on, Tim. It just kind of bringing back history. I think what's kind of important to note here is while we saw, 2% and 3%, low 3% interest rates over the last 2 years, that's not what we've historically seen. And actually, where rates are today for multifamily assets on a 10-year fixed rate basis kind of ranges anywhere from, maybe a low of 4.5% to a high of 5.5. Obviously, you could kind of go outside of that boundary, just really depending on the property's cash flow, the loan to value, the interest only period, if there's any, special attributes, affordability, green improvements, et cetera. But this kind of brings me to a poll that I'm very curious to hear from the audience on. And the question is how many multifamily loans have you closed in the past that had an interest rate of 5% or more? So we've got about 57% of the audience has not actually financed a loan that had an interest rate of 5% or more. 19% has had 5 or more loans that have hit that level. 3 to 5 loans is coming in right around 10%. So definitely a mixed bag here. I think this is interesting. I think, obviously it depends how long have you been a real estate investor as to whether or not how many cycles have you been through where you've, seen this volatility and fluctuation in interest rates.
Yeah, Ali, I think it looks like a little bit of a mixed bag. And it could be, we've got some folks in the audience who either have been financing actively, just not at 5%, or we really just have folks who have not financed their first multifamily property yet. So interesting poll. Thanks for asking the question. I appreciate the results and everyone's participation. So kind of circling back a little bit, obviously we're talking about interest rates here, and Tim has really focused on the 10-year Treasury in his example. So just, I kind of want to touch on, why do we care so much and talk so much about the 10-year Treasury? There are obviously other Treasury rates, for example, the 5 and 10 and 7-year Treasury. We tend to highlight the 10-year. We use this as a baseline for our analysis for most permanent loans. This is just generally the index that applies to most of the permanent loan financing in the multifamily market today. We have a group of very experienced traders here at Walker & Dunlop who do keep our experts apprised as to where interest rates have been, where they're going, what's impacting where they are today. But given all of the political uncertainty and inflationary factors, while we're not really certain where rates will be in 2023 and 2024, we generally have a pretty strong indication that they will continue to rise, at least in 2022. So now is a really good time to lock in an interest rate that, relatively speaking, to Ali's point earlier, is still very low. Interest rates ranging from 4.5% to 5.5% today, still very good interest rates and very much at a level where many investors have been interacting in the past. Our perception is a little bit skewed because we are coming out of experiencing some of the lowest interest rates historically. So we sometimes just need to kind of keep that perspective in mind and remember that these are still very good rates.
Absolutely. So next, we're going to dive into the current landscape of available debt sources. Today, we're focusing just on multifamily assets that are in the $1 to $15 million space. But some of these debt sources that we're going to touch on obviously are available for also the large loan space. So I think it's important to note that obviously we're in just a unique time in the market right now. There's a lot of uncertainty, there's a lot of fluctuation, and it's critical that investors work with a lender that have the capacity to canvas all the debt sources. In 2021 alone, Walker & Dunlop sourced transactions from 350 different capital providers. This allows us to serve our customers and match them with a loan that meets their business plan. So now Tim and Allison will dive into the multifamily debt sources, including agency, HUD, life insurance companies, bridge lenders, CMBS, and banks. Allison, let's start with you.
All right, thanks, Ali. So we'll start just kind of working left to right on your screen here. We'll start with Freddie Mac and Fannie Mae. These are both government-sponsored agencies. The loans are generally categorized as some of the most attractive types of financing for experienced multifamily investors. The loans do not require tax returns or deposit relationships of any kind with a bank. Kind of good times and bad. The agencies are somewhat agnostic to changes in the economy, and they're always focused on fulfilling their mission to support affordable housing in the United States. As a matter of fact, their mandate is to provide financing to 40,000 multifamily units for multifamily properties that are between 5 and 50 units. So some of those smaller multifamily assets that we're focused on today. So Freddie Mac and Fannie Mae are very, very, very driven to meet the financing needs for these properties. Walker & Dunlop is a direct lender for these agency loans. We also service these loans. So let's kind of break Freddie Mac and Fannie Mae apart a little bit. We'll just dive in briefly to each. So Freddie Mac, actually both Freddie and Fannie, all of these loans are non-recourse, and Tim will talk a little bit about that more later. Both Freddie Mac and Fannie Mae do allow for up to 80% loan to value financing. Both provide opportunities for cash out. Debt service coverage ratios, which is essentially a comparison of your net operating income to your annual mortgage payments, as low as a 1.2, which is relatively low in the market. Freddie Mac in particular also offers pretty flexible prepayment structures. So a lot of people think of agency loans as really kind of only being a 10-year loan where you hold that for the whole 10-year period, where there really are a lot of flexible options. Again, particularly with Freddie Mac's small balance, there's even one option that is open at year 3. So at the beginning of year 3, you could prepay the loan with no penalty whatsoever. Freddie Mac does also allow for financing for experienced non-US citizens. With turning over to a little bit more to Fannie Mae, so Walker & Dunlop is ranked as the #1 lender with Fannie Mae, and we have been for 7 out of the last 10 years. So we certainly have a very experienced, well-seasoned team to help you out. The Fannie Mae loans do allow for a little bit more of lender discretion, so a little bit more flexibility there. They also allow for subordinate financing, full term interest only, and they have loan structure options up to and including even a 30-year fixed term with a 30-year amortization. So that's kind of a brief summary of Freddie Mac and Fannie Mae. Tim, do you want to kind of touch on HUD a bit here for the audience?
Yeah, absolutely. Diving into HUD, this is another case where Walker & Dunlop's a direct lender like Freddie and Fannie. HUD insures the mortgage, we make the loan. HUD has a refinance program that offers a 35-year fully amortizing loan term, can get slightly higher leverage than Freddie Fannie, up to 85%, 80% if there's cash out. And we can underwrite down to a lower debt service coverage ratio. Ultimately, the hope is that means more proceeds with a HUD execution. Common misconception is that we only finance affordable or rent-restricted properties through this program, but that's not the case. We actually do plenty of market rate properties through our HUD platform. And I would just note that probably the key consideration is timing, particularly when you're talking about managing interest rate risk in this environment. For a market rate refinance, it's taking about 6 months to close, 5 months to get to rate lock, and that assumes that there's no backlogs with HUD or hiccups along the way through the processing. And then switching, kind of going across the chart here, switching from direct loans to instances where we're an intermediary. The life companies, in this space, Walker & Dunlop works with the whole universe of life companies who are active in the commercial mortgage markets. And in many cases, we have exclusive relationships and we service those loans. So life companies tend to target they're known for targeting low leverage, institutional quality, well-leased properties in major metropolitan areas, and often at really attractive rates. But that's not always the case. You can kind of break down life cos into like small, medium, and large. On the large side, those groups are likely targeting loans in the $25 to $150 million space, sometimes larger. A lot of those groups are household names that you may be familiar with. In the middle markets, that segment's really looking at 5 to 25 million. And then when you dip down to the small market space, call it maybe 1 to 10. We have some lenders that top out at a $5 million loan amount. So there's really something, a home for every type of deal in the life company space. But in the small and middle market space, these players are often willing to kind of stretch, go to smaller towns, smaller markets, maybe push leverage to get more yield. So, conventionally, you think of life cos as chasing trophy assets in major metro areas, but for some lenders in this space, kind of the old, ugly, and lease works just fine. And then, so that's life companies. And switching to CMBS, this is a type of execution that's generally viewed as the lender of last resort for multifamily loans in particular. But it can be a good option for transactions that aren't a good fit for either the agencies or the life companies. Maybe you have a sponsor with a credit blemish or a unique property attribute that kind of forces you to look at a CMBS transaction as opposed to the others we just talked about. We tend to work with shops and originators that we know and trust because there's a lot of inherent volatility in this space. So our overall goal when we take on an assignment that goes CMBS is to sort of remove the friction from the process. It's key to note that we don't rate lock until just before closing. So your rate is kind of bouncing around, subject to market movements. And then after the loan closes, there's commonly a lot of frustration with the loan servicing side of things. So just to round out, you can contrast a CMBS process with the life companies who we just talked about, who have a very predictable credit and closing process, rate locks at application. Walker and Dunlop, as a correspondent, orders third parties, so we can engage appraisers and engineers who we know and trust. And so certainty of execution on the life company side and Freddie, Fannie, HUD, and that's not always the case with CMBS.
Thanks, Tim. So moving along, so bridge financing here. So Walker and Dunlop is a direct lender in the bridge and proprietary capital arena, but we do also partner with external sources across the market, really kind of canvas the market to find the most attractive deal for you. These bridge loans are generally geared towards properties that require additional stabilization or rehab funds to upgrade the property. Oftentimes in an acquisition where you're looking to acquire a property that maybe isn't stabilized due to some recent event, for example, if a fire took place and took down some of the units, and the current owner wants to sell it, you might need to look for some sort of bridge financing to help get you to that permanent financing once the property is rehabilitated and stabilized. These loans are often looked at as kind of a stepping stone to a refinance, permanent loan transaction, or ultimately potentially a sale. We often can underwrite to what we call a pro forma net operating income. And really what that is essentially, we look at the cash flow as it will be once the property is stabilized and fully occupied versus where it is today. And what that means for you is more loan dollars and potentially additional funds to do some of the rehab work. The terms of these loans are generally shorter, typically 2 to 5 years. With floating interest rates. So you can also purchase an interest rate cap to kind of protect yourself a little bit from rapidly rising interest rates. So those are the bridge loans, shorter term, more flexible, transitional.
Right, and then switching to round out the chart here, banks and credit unions. We work closely with regional, national credit unions and national banks across the country. We're partnering with these groups to place construction loans, bridge loans, or just conventional refinancings, generally with like a loan term ranging from 3 to 7 years. And the banks have been really active recently, but they are heavily regulated, so they can tend to pull back in uncertain times. So we're keeping an eye out for that, but we don't expect the banks to disappear. Some drawbacks, kind of considerations when you're doing a bank loan. These loans are typically recourse, which means that a lender could come after you for your personal assets to make them whole if something were to go wrong at the property. The loan documents often include covenants, which if these are triggered, you could be asked to right size or pay down the loan or even pay it off at an inopportune time. So Again, compare that to Freddie, Fannie, HUD, Life Cos, which are non-recourse and truly permanent loans throughout the life of the loan.
I mean, I think you guys have covered all the key players in the debt markets. And right now what we've got on our screen is actually just a grid that we've prepared. And I know it's probably a little bit hard to read. This kind of just gives you an outline of the various terms that you can get from these different sources. And, I think Tim hit on something that's pretty important. We don't expect any of these lenders to truly be on the sidelines, but we do expect them to, probably change a little bit of their credit underwriting, maybe, slow down some of their lending. So it's really, really important right now in these, markets where we're fluctuating so much on a day-to-day basis to basically make sure you're working, with a financing expert that can canvass the market, because some lenders are going to be in the market one day and maybe, hitting a little bit of the brakes or pause the next day. So I'm just going to move on to our next poll, which is, what financing sources have you tapped for your multifamily properties in the past? And this is covering all the lending sources that we just talked about. So local bank credit unions, national banks, agency lending, which this is Fannie Mae and Freddie Mac, HUD, life insurance companies, and CMBS, and then other, which would be seller financing, et cetera. All right, so the results are in, and it's by far local bank and credit union. So 70% have been working with their local bank or credit union. We've got 47%. So again, national banks. So I think combined right there, that's definitely the leading source for most of the audience here. About 41% have financed with agencies in the past, 16% with HUD, 15% with life companies, 13% with CMBS, and 25% in the other category. So definitely a wide variety here. I definitely expected to see, a lot of people probably using multiple lending sources, really just kind of depending on what, their business strategy is and what their financing need is. So that's great. All right, so we're going to move on to our next section, which is really focusing on managing interest rate risk. So Allison, let's start with you. What are some of the key strategies for managing interest rate risk with the agencies in the capital markets arena?
Thanks, Allie. I appreciate it. I think we're kind of getting to the part that most folks are very interested in here. So this is an exciting topic. So, first I would like to kind of talk about some of the loan program features that can help protect you. We'll then kind of move into some things that you can do proactively, but first we'll focus on the loan programs themselves and the features that they have. So Freddie Mac's small balance actually holds their interest rate at application. So the day that you sign the application and get started on your loan, that rate will be held all the way through closing. So particularly in an environment like this, that's a very, very attractive feature. For larger loans with Freddie Mac, although they don't hold the full interest rate at application, they do allow for index locks, which will help you hedge against rising treasury rates. Fannie Mae has what is referred to as a streamlined early rate lock option. This allows you to lock in your interest rate several weeks after going under application and well before your actual closing date. Tim touched earlier on the life insurance company loans. Those rates are also typically held at application. So those are some of the biggest features of the loan programs that we have in our suite today that will help protect you against rising interest rates. Some things that you can do on your end, obviously, one of the most obvious is start today. There's never a better time than today to lock in your interest rate in a rising environment. Work closely with your lender to quickly supply loan documentation. So our goal is to get you to a locked interest rate as quick as practically possible. And to the extent that you can provide us with the documents that we're requesting along the way, it will certainly help us. Documents such as your resume, historical profit and loss statements on the property, those sort of things that help us advance your file to closing. Another thing you can do is really, take a look at your schedule of real estate owned. You may have loans that, 6 months ago, you would say, hey, I'm not going to refinance this for another 2 years because my, interest rate is fixed and it doesn't start adjusting until 2 years from now, or I'm in a loan that has a prepayment penalty and it doesn't burn off for another 2 or 3 years, so I'm just going to stay here. Maybe your interest rate is lower today than where interest rates are. So you're thinking this is not the right time, but oftentimes it can make really good economic and financial sense to go ahead and do the refinance now, because you're not certain where the interest rates will be at that two-year mark when your loan matures. And having that ability to lock in an interest rate for potentially up to even 30 years in what is still arguably a good interest rate environment can oftentimes make sense. So taking a look at your schedule of real estate owned. Also, do you have any loans in your portfolio right now that are floating? You may want to consider converting them to a longer term fixed rate loan.
Yeah, that's great. So, I think the other thing important, and it's probably on everyone's mind right now, is the correlation between cap rates and interest rates. And we're actually at a pretty unique spot right now. So, with treasuries now above 3%, but cap rates at still historic lows, kind of in this lull, like they haven't actually moved in lockstep together. The other thing we're also seeing is that properties and investors are still seeing about 10 to 20% rent growth year over year versus historic levels of 3 to 5%. So this robust rent growth yields significant increases to the bottom line, to the net operating income, which it actually drives up the effective cap rate for your year one. So you could close at a much lower cap rate on your loan, but then the rent increases actually drive up your NOI. And at the end of the year one, your effective cap rate over that time period is actually higher than at the end place when you close. So it's important to think about where we are in the market today. And, some of these assets are really stable. There's, stable fundamentals in the market for commercial real estate still. So typically, like I mentioned, interest rates and cap rates, they don't move in lockstep. It could take us 3 to 6 months or even more to see adjustments to cap rates, which will ultimately affect the value. But continued rent growth levels will also have a major impact on where cap rates go. So what does this all mean? This means that in a more stable market, you might easily achieve 80% loan to value. But today, you may only receive 65 to 75% of the current valuation. This is all dependent upon the property's cash flow. And this is primarily what we're talking about is non-recourse loans. So again, for non-recourse debt, you're really focused on the property's operation and historical performance. So that leads me to my next question for Allison and Tim. What can investors do today to help lenders achieve a higher leverage point for their debt?
It's a great question. So, I often think of things in terms of what can I control and what can I not control. In terms of closing this gap between, say an acquisition price and where your leverage is, you obviously want the highest loan to value possible. Some of the things that you can do to control that, ultimately the loan amount is driven by your net operating income. So you'll want to ensure that your expenses are as tight as you can keep them, because that increases your net operating income, which will mean more loan dollars for you. So pay careful attention to things, operating expenses that you can control, your management fee, review your agreement, make sure that there aren't any unnecessary or out of market fees that you're paying, payroll, how you run your repair and maintenance, how efficiently and effectively you run that. If you're looking to acquire a property, have a budget prepared for your lender, refine that budget. It's really a way to show your lender how you plan to operate the property. The current owner may be paying a 6% management fee, but maybe you've secured one at 4%, which would effectively increase your net operating income and ultimately your loan dollars again. So make sure that you have that budget. And if you need assistance with it, you can work with your financial advisor as well to help you with that. Having a good budget on a cash out refinance. So if you're looking to acquire a property and maybe you're only at 65% loan to value, but you have another multifamily property in your portfolio that has some equity, you can actually do a cash out transaction on the property that you currently own to take that cash to help bridge the gap for your down payment on the acquisition of a new property. Also, be sure to break out the capital expenditures on your profit and loss statement. So any of those big ticket items that are one-time expenses, not typically recurring year over year. If you replace the roof or do new windows or repave the driveway, those are typically referred to as non-recurring capital expenditure items that you can kind of strip away from your expenses, which again increases your net operating income and ultimately then your loan dollars. Another couple things that you can do in terms of how you structure your loan, take advantage of interest-only options. So for example, an interest-only payment for a loan at say a 5.5% interest rate equals the same monthly mortgage payment as a 30-year amortizing loan at an interest rate of 3.65. So if your current loan is at 3.65 and it's maturing in 2 years, it may very well make sense for you to refinance now at a 5.5% interest rate. Your mortgage payment would essentially be the same, so your cash flows would look the same, but yet you're securing yourself in that longer term debt, which can be very helpful in this type of environment. Also take advantage of pricing discounts. So the agencies in particular, Freddie Mac and Fannie Mae, do offer pricing discounts for buildings that are affordable because it ties right back into their mission to provide financing for affordable housing across the country. Also, if you make certain energy efficient changes to your property, you can also qualify for additional discounts there. So all of these things to kind of drive your interest rate down, again, which equates to higher loan dollars.
Thanks. Yeah, I think the only thing we haven't probably discussed yet is construction and lease-up deals. Tim, let's go over to you. Would love to hear, what approaches should investors consider for properties nearing construction completion or lease-up?
Sure. Yeah. So first, it's never too early to get us involved in projects that are even in the planning stages or during construction, kind of moving towards stabilization. We're tracking a number of properties for clients who are leasing up their project, and they're sending us maybe a monthly leasing report or even weekly sometimes. So we track the numbers, and there's sort of an inflection point where you can start taking it to market, taking it out to lenders. On the life company side, you can go a little bit earlier. They're more willing to take a little bit of lease up risk on occasion. Certain life companies will even fund at break even, essentially when the property has sufficient cash flow to cover the loan payment. Or alternatively, you could structure a forward rate lock where we're locking your rate today, but we're funding that maybe in September, October, when you're sort of projecting that you're going to hit a stabilized occupancy level. So on the life company side, you tend to be able to move a little earlier. Rents are really not the issue. Rents are coming in higher and higher, and demand for these units is generally strong throughout the country. So start early is kind of message number one. Separately, if you can show a clear path to stabilization within, say, 120 days of closing, Fannie has a near stabilized program that we can explore. And then just finally worth noting, kind of relatively new news, that HUD recently opened the door to allow us to refinance newly built properties. Historically, we had to wait 3 years before taking advantage of their refinance program.
Yeah, that's great. Well, I think you guys really dove into some really helpful insights here that can help borrowers think about, their property operations or financing programs that might be out there to increase leverage. And that was just some really great insights there. So thank you both. So one last poll, and then we'll actually move into the Q&A section. And, I'm really curious, it's particularly given our first poll where not many people had actually been in an interest rate environment where rates were north of 5%. But if rates were continued to rise and they hit 6%, how active will you be on multifamily acquisitions and refinancings? And I think to probably maybe make this a little bit tighter, let's talk about the next 12 months. So this is interesting. And this, I think, kind of speaks to the market fundamentals, which, we definitely feel that they're very strong. So only 10% will sit on the sidelines. 46% will transact only as necessary. So this would probably be maturing, loan maturities, or they're coming off of an interest-only payment and they want to increase cash flow and get back on an interest-only payment. And 44% are going to continue transacting at the same pace. That's great. All right, so next, before we jump into the Q&A, I just want to remind everyone of some quick resources. As I mentioned earlier, you all will be receiving slides via email after the webcast, but you can also download our financing guide. You can also visit our quote app tool that can give you a tailored quote for a specific property that you may be looking to acquire or refinance. And you can always send us an email to be connected with an expert. All right, so now let's open it up for Q&A. All right, so I'm going to start. We did get a few questions earlier on. And first, before I dive into anything, if we run out of time, which we likely will because we had a lot of questions that came through, we do have your guys' contact information from the registration. We will have somebody reach out to you to be able to supply you with the answer you're looking for. All right, so first question. How to optimize bridge financing while waiting for HUD 223F loans. Tim, you want to take this one?
Sure. Yeah, thanks. Happy to take that one. It's probably number one, as I mentioned, it takes about 6 months to get through a conventional refinance execution with HUD. So you're going to want to make sure you have at least 9 to 12 months on your bridge loan term, maybe with some extension options to allow a little buffer in there. I would also note you probably want to bake in prepayment flexibility. And then third, maximize that bridge loan, because particularly on an acquisition, if your bridge loan is less than, say, 85% LTV, HUD won't consider it cash out, assuming you have a loan that is 85% LTV or higher. So you could be looking at a situation where you actually have to bring more cash to closing if you're not maxing out your bridge loan.
All right, so we're going to move on to the next one, and I think I will take this. But people are asking, what kind of cap rates are you seeing in different areas of the country? And what's kind of interesting is over the last 2 years, we actually haven't seen this wide spread between top markets, secondary markets, or tertiary markets. And I think that's because the cost of capital has been so low and rent growth has been so high. But we'll start with the small to middle market space. So I'd say on the low end of the range, we're still seeing about a 4.5% as, call it the low end, but we are seeing, for smaller assets up to about a 5.5% cap rate there. And then in the larger space, there are still a few deals transacting at an in-place cap rate just slightly below 4%. But as I mentioned earlier, these deals are seeing massive rent growth. So that effective cap rate is north of a 4% number, by the end of the year one. And that's really how institutions look at it. They look at what is my stabilized cap rate. And so they're really forecasting out where they will be once the market kind of stabilizes and absorbs that rent growth. But I think, again, we're going to really closely track rent growth in markets. If we continue to see significant rent growth in all the areas, I don't think we will have a significant increase to cap rates across the board. I think we will have an increase to terminal cap rates, which is the cap rate that you would look at in terms of your IRR analysis, forward casting out, if you held the deal 5, 7, 10 years from now. I think all of those have adjusted upwards. But while rent growth is strong and significant, I think everyone's really kind of looking at, what is my effective year one cap rate right now?
Yeah, and Allie, I think I see a question in here. Someone has asked, when would you use HUD over Fannie and Freddie? I'd be happy to take this one. So typically, HUD financing is very attractive. The interest rates are incredibly attractive. The leverage is typically very high, amortization periods up to 35 years. So it all sounds amazing. So one would say, why would you not just take a HUD loan for every deal? HUD loans, you really need to have time to be able to execute. So if you have that time, a HUD loan may make a lot of sense for you. After a HUD loan closes, there are a lot of reporting requirements. So typically, most of my clients that would execute on a HUD loan have an in-house financial group that can help kind of manage the financial profit and loss statements and a lot of the HUD reporting. So if you have that expertise in-house and are prepared to do a lot of that post-loan closing reporting back, HUD could make more sense in exchange for doing a little bit more work and waiting a little bit longer. you will have those really low interest rates and long amortization periods. So I would say Freddie and Fannie offer a lot more flexibility in terms of getting to closing more quickly and less diligence after closing.
Okay, we have a lot, so I'm going to do my best to ask these questions and answer them myself in the next couple of minutes so we can keep moving. So any changes to agency fees? So the way it works with Freddie and Fannie is they have obviously minimum origination fees that every direct lender, which Walker and Dunlop is one, can charge. So it's an even playing field across the board. So there is no change to that agency fee right now. Here at Walker and Dunlop, we're obviously really focused on the borrower's all-in cost. So we want to make sure that we're getting the best, cost for third-party reports, due diligence, et cetera. But there's no actual change per se to agency rates. Which options give you non-recourse? So actually all of the options that we talked about today are non-recourse options. I would say the one that tends to lean more recourse is actually bank financing. As Tim mentioned, most of those deals have some level of recourse tied to them, whether it's 25%, 50%, or full recourse. A lot of that depends on your balance sheet, so your net worth, the amount of cash you have on hand, and obviously, the economics of the deal. So is it a really low 50% valuation or loan to value, or are you asking for 65, 75%? Does W&D offer financing for other commercial interests, such as self-storage facilities? We do. We actually finance all commercial real estate. So we do hotels, office, industrial, self-storage, all types of multifamily. There really isn't anything that we're not going to touch here. So happy to connect you with an individual. Will a bridge loan work while waiting for a 1031 sale? Yes. So the important thing here is that it may not actually need to be a true bridge loan in the bridge lending sense, but the key is to basically find a loan, and we have obviously access to that, but find a loan that has flexible prepayment penalties that will allow you to have the loan outstanding, for less than a year, but that can be done. Since treasuries have been on the rise, have spreads moved? And if so, in what direction? So this actually depends on the lending source. And there's a later question here asking about the agencies and whether or not they have hit their allocations for the year. So in the agency world, which is Freddie Mac and Fannie Mae, we actually have not seen spreads increase. If anything, spreads have continued to decrease. And that is because they are very much trying to serve their mission, which is to basically provide affordable financing or financing for affordable housing right now. We are seeing credit spreads widen out. So in the CMBS world, in the bridge lending world, CLO market, those credit spreads are widening out, but it's not in lockstep with what we're seeing in the treasuries. It's just slight movements there. What's the best option for construction of multifamily properties? So this is I would say there's three groups really that are probably your best option here. And so that would be the HUD 224D program. That is a construction program that can get you up to 85% of cost. As Tim mentioned earlier, that it does take a while to close. It can take over 12 months. So if you don't have time on your hands, your next two options would be bank financing or debt fund financing. And that really just depends on, what leverage point are you trying to get to, what the size of the loan amount is. There's a lot of debt funds that won't play in the sub $10 million space, which would then leave you ultimately with mostly banks. Well, we have a ton of questions here, and I apologize that we were not able to get to all of them. But as I mentioned, we will be reaching out to all of you to make sure that you can speak with an individual, an expert that can address the questions that have been posted. Thank you for your time.